us introduce.
I'm Jeremy with ChainView Capital. We have a hedge fund and a VC. I run the VC side of the business.
Dhruv, co-founder and CEO of Arch Lending. We're a wealth management and private banking-like platform for people with alternative assets. We focus on lending primarily against these assets, Bitcoin and others included.
Hi, I'm Annelise Osborne. It looks like we get to know everyone by name here because we've got a small crowd. I am Chief Business Officer at Kadena, which is a layer 1 proof of work blockchain that was founded by 2 JP Morgan gentlemen back 5 years ago. It's been live. I also have a book that just came out this summer called From Hoodies to Suits, Innovating Digital Assets for Traditional Finance. And I brought some, but I left them in my car. But I will leave some in there after the panel. Thank you.
Awesome, guys. Thank you for that. I guess let's start by talking about what are capital markets, right? I think, some folks might know what exactly that those words are, and some folks may not. But what are capital markets for each of you in your own business? What does that mean?
Lending markets and capital going into early stage startups. It's the most relevant areas to me.
Yeah, quite similar. I mean, like capital markets is just the intersection of people with money and people seeking it. And so for us, as a lender and a startup, we raise venture capital, but we also raise debt capital. And so we talk to private credit funds and different debt capital sources to then further lend out to our customers.
Mine is more traditional. I've always been focused on how do we upgrade finance. So I worked in traditional finance for 15 years, mainly in structured finance, but I have done kind of M&A and different hats. So I've always been focused on how can we make institutional digital assets kind of in the regulated space? How do we recreate bonds? How do we tokenize funds? How do we create private market assets that are more efficient and affect a more broad spectrum of people than do today?
Awesome. Annelise, let's start with you now. In an ideal world, what are some of the best, in your opinion, in your experience, use cases for tokenization in capital markets?
So I love fixed income. I'll put that out there first. If you think about any bond or any transaction, it's really a legal document's an Excel spreadsheet talking about where the money goes and flows, and that if it's an Excel spreadsheet, it can be put into a smart contract, right? It can be programmed. And so that thought process of having fully automated bonds, to me, is super exciting, fully automated servicing. So that is obviously something that is near and dear to my heart because I think that can be done. We just need to upgrade the systems and the interoperability for that. I also think that obviously the tokenization of funds is something that has taken off. It's been proven to have I think for anything to happen, you have to either increase revenue or you have to decrease expenses. And so if we look at loans that have been done, Mike Cagney and Figure have been able to highlight 150 basis points in savings. Then if we turn to tokenization of funds, Franklin Templeton believes that all funds will be tokenized because it's so much more efficient and effective. I also think it opens up the investment, since it's more efficient and it's a lower cost to bring on new investors. You can open up private equity funds to lower minimum buy-ins, and that I think is really advantageous to kind of average investors. And average investors, you have to KYC AML and you have to be accredited for certain issues. I think that's a big step too. But also my other one that I will say for my 3 is programmable money. So I feel like we'll talk about digital dollars. We'll talk about stable coins. I feel like a stable coin and PayPal's offering of a stable coin to 436 million wallet holders that don't even realize there's blockchain behind it. I think that's really going to push the markets for adoption.
Yeah, I think one piece, and we're working on it on our side, is really tokenizing private credit. And so here we've raised like a warehouse facility, and we're in the process of tokenizing that so that other institutional investors can buy the debt and make it more transactable. And so you go from a private one-to-one transaction to opening up the world of people that can now get access to this asset class.
Yeah, for me, I'm really in the camp that New York, London, Singapore are pretty established, efficient capital market hubs. Certainly, for U.S. institutional adoption saving 50 bips, 100 bips is significant, but you need quite a bit of volume to incentivize adoption. For me, I'm more excited about emerging economies, and on-chain finance brings transparency and trust, and it makes a lot of projects and opportunities investable compared to the latter traditional route. So that's what I'm pretty focused on with regards to tokenization.
Awesome. And I guess, Annelise, you mentioned a few different use cases, institutional use cases mostly. Where do you see the roadblocks? Let's just take fixed income, right? Tokenizing fixed income. Where are the biggest roadblocks to sort of mass adoption of that?
Sure, I kind of look at 3 roadblocks for mass adoption as well. One is education, which, to be honest, which is why I wrote the book, because I feel like not everyone understands the benefits of this technology, which includes regulators and legislatures in the U.S. I think that's a big holdup. I think if we look specifically at fixed income, more is being done in Europe. There's a lot of bonds that have been done in Europe as tests there. I think the second is regulation, which is the reason it's been done in Europe is because MiCA is a little bit more open in regulation, and it's not gray. In the U.S., a lot of the regulation is gray, and you need to be black and white. You need to know what you can work with. Otherwise, institutions can't touch it. And then the third is interoperability, which takes a couple different hats. One, it's how an institution operates with a chain. How are they if we're going to get rid of intermediaries, we still need to have those intermediaries generally from a regulatory perspective, so like transfer agents and the like. But also the interoperability kind of between chains is, if I'm wearing my crypto hat, it's between chains. If I'm wearing my institutional hat, it's from institutions. A lot of say for a bank, for example, each department has built on top of their tech stacks, and it's different than the other department within the same bank, because a lot of that has to do with regulation and having to track, keep your records up to date. And so it's just easier to build. And so that is more difficult when you have people build things are COBOL in the very lower levels, and that versus APIs that you can plug into on chain. So I feel like that's the third problem with adoption.
Have you seen any progress from, say, 5 years ago or however many years ago to today?
5 years ago. Not as much as I would have hoped, right? So I feel, for example, we go back to 2018, which was 6 years ago now, and the Aspen coin launched. And the Aspen coin was a digital shares of a hotel in Aspen, Colorado. And it offered also utility benefits, because one of the things that this technology can also do is offer utility benefits like upgrades and champagne and all sorts of different things. It could have monetary value, could technically break away, but not as much has happened. I think one of the problems is the buy side, right? I don't think we can create, it's a balance. We can create products, but I don't know that people are there necessarily to buy them, because I don't think the benefit has been brought out. The cost benefit analysis of having large institutions actually worry about custodying them.
Gotcha, thank you. Dhruv, in your world, you mentioned you guys raised a warehouse facility. I presume is that from a traditional TradFi type of place or a crypto focused or a collective of companies?
Yeah, so we had term sheets from both, but we went with Galaxy, who's more of a crypto focused lender.
Gotcha. And what if any roadblocks, if you're imagining sort of an ideal scenario where warehouse facilities could be tokenized, for example, what sort of roadblocks exist in that?
Yeah, I think you basically are mimicking a regular securitization. And so a few things that come up, one is just on and off ramps. I think most people think they're solved, but when you're moving serious amounts of dollars, even we run into hurdles of just limits at various companies. You have transaction fees that are still quite high relative to what they ideally should be. And then the second piece is also accountability. So in traditional finance, you have a Moody's, S&P, rating agencies that then allow larger pockets of capital to invest in these sorts of bonds. But for us, working with different types of companies that can help maybe verify balances on chain, things of that sort, are still needed to unlock that sort of feature, if you will.
So more like service provider availability, sounds like some technical improvements, that kind of stuff.
Yeah.
Have you seen, are there examples of folks that have done these sort of tokenizations that come to mind?
Yeah, so I think For both. On the on and off ramps, we've seen a company called Conduit Financial sort of helping streamline, that transfer between fiat and USDC or other stablecoin pairings. And then in terms of more of like functioning as the rating agency, we've seen a company called Accountable. They're sort of working to ensure that you can have maybe proof of reserves and things of that sort on chain that other investors can look to before they make an investment.
Gotcha. Thank you.
Can I add in that the rating agencies do want to be involved, and so S&P and Moody's both have departments, and they're always coming out with research because they look at it as a growth area. So I know they did things with stablecoin, and I know they rated Compound previously as well. So anyway, food for thought in that.
Yeah.
Right. Thank you. Jeremy, I know you invest in equity and you guys raise capital, obviously. What challenges, and opportunities exist specifically in the equity space or VC space, if you want to focus on that?
Specific to blockchain and crypto companies, I really think it's exit opportunities. M&A is not been what a lot of folks or VC folks have been raising capital on. In terms of banks in the U.S. that have been purchasing crypto companies, there's probably only a handful at this point, and usually it's for regulatory purpose or adding on to a broader platform. So until a lot of the larger financial conglomerates speed up purchasing, I don't think additional resources will continue to flow in.
What about specific to tokenization? Do you see any opportunities for tokenizing, whether it's at the fund level or other things related to equity in general?
Yeah, if you can get to economies of scale, for example, Securitize working with BlackRock and some of the larger private equity firms, saving the 50 bips makes sense if you're doing large volumes. It's come a long way. There's a pretty big graveyard for tokenizing assets since 2018, and it'll certainly continue, but at a pretty slow pace, in my opinion, until other folks beyond BlackRock get on board. It's going to be more pilot programs than broad adoption.
Gotcha. Okay. Annelise, we talked briefly about programmable money, stable coins, right? We have Circle, obviously, that's a local company. How are stable coins participating in the capital markets economy, if at all? And where do you see potential improvements in the next year or two that they could focus on?
Sure. I cashed a check a couple months ago. It took 5 days to clear. Right? I feel like that right there, if you're an institution and it takes 5 days, which is not that long for an institution transferring money or cross-border, if I can transfer it immediately, then I can put that money to work right away. And I think that is a huge kind of increasing the velocity of money and the opportunities for investment, not just from a personal perspective, but from an institutional perspective, that's big. If you look at all the money that is spent on cross-border transactions, and I used to have this figure, I don't remember what it is for last year, it's tremendous. And something like stablecoin can help from the institutional perspective. Now, institutions aren't really ready yet, I think, for stablecoin, especially if we're dealing in the U.S., because there's questions about there's a bill that's going out about stablecoins, and there's questions for regulation. But I do think that there's big steps. I know that Circle is also looking at other economies that have less stable currencies that they can put it into a stablecoin. We're doing a bunch of deals down in South America, and I think South America is much more crypto-oriented, partially because of the volatility of their currencies. They can put it into a stablecoin. I know banks also are looking at stablecoins. JP Morgan has their own coin. You might be familiar with JPM coin. It is an internal stablecoin to JP Morgan it's backed by depository receipts, so it does not leave JP Morgan. But JP Morgan clients don't even recognize that a stablecoin is being used because they just look in their account. JP Morgan has also changed they saved $20 million last year, which is kind of a drop in the bucket for the amount of money they've put into technology, but it's also a fraction of what they're starting to do for their internal repo. So they've been able to price, because this is all programmable, they've been able to change repo lending from 24 hours down to the minute. And so that has a lot of this cost savings has to do with that. And that's when they were only doing about $1 billion a day, and now they're doing almost another zero on that. So there's going to be a lot more savings going forward. So that's a different type of programmable money that you have internal. There are also another of other banks. I believe there's 4 banks right now that have their internal stablecoin. So that's something to think about too. I don't think banks. There was a question of banks offering their own stablecoins. I don't think that makes much sense, because think about the beginning of money, right? Banks offered all these notes before there was a federal currency. So I don't think that makes sense. But I do think it would make sense. Tether, the institutions can't use, right, because it's not regulated, though it is the largest stablecoin. So you have USDC, but I do think there will be more competition for USDC. Do
you feel that, I'm sorry if I'm kind of repeating what you just said, but do you feel that banks are the best issuers of stablecoins or not?
I do not believe that. I think banks, banks are in the process of money. Like, they're in money. They're money movers. They're savers. They're lenders. That's really their business, is holding money and lending it out. I don't think they should be creating money. It doesn't seem to me like that makes sense. And that also goes back to the early currency. I will also tell you that a lot of other banks don't want to use JP Morgan coin because they're a competitor to JP Morgan. And so I feel like there are other opportunities. And even look at Visa and MasterCard. They're playing in the space. I think they make a little, like, as payment companies, and the whole rise of fintech has been so focused on payments for years. I think PayPal makes a lot of sense. I think, like, USDC people that are focused on this, I think, are a little bit more... I think there's more opportunities for them to be leaders. Look at different countries as well. Sorry, look at China, right? You used to have, now they're doing a CBDC, which is a central bank digital currency. But part of that is because you had WeChat and Alipay that were 2 private companies that had a majority of the payments markets. And China is a different economy than we are, and there's more of a surveillance state. So I do think there's opportunities outside of Facebook Libra, if you remember that, to develop in the U.S.
Gotcha.
I think there's 2 pros and cons to banks issuing stablecoins. And on one hand, they could save a lot of money, increase margins. The other hand, their margins are going to be suppressed if checking and savings accounts essentially converge, right? You have a lot of money market funds, sweep accounts. Eventually, all idle dollars should be yielding a return for retail, institutional alike. That's going to eat away at how banks make money. But on the other end, instant settlement, if they implement that in the back end, they can hold on to a lot of that idle cash and ideally get additional yield. So it's going to be a interesting next 5 years, and how these banks adopt and what they choose to push to the market.
Dhruv, what about yourself? How can stablecoins play a role in sort of the debt, the asset-backed debt that you guys are building? Do they play a role now, or could they play a role?
Yeah, I think for us, it's really been more so about like speed of transactions. And so when we see borrowers that want to borrow in stablecoins, they can complete a loan application and get funds within 20 minutes. And that's unheard of, in the traditional system where you're applying for a personal loan, mortgage, things of that sort. And so I think the speed is really one key component. The other is also, like, stablecoins have existed previously in a different sense. Like, you can think of Venmo as one as well. It's a digital representation. The money in Venmo is not earning a yield. And so I think there's ways, as you were alluding to bring yield to those assets so that people can mimic what a money market fund looks like and make more use of just actually using them, or maybe having them sit idly and saving in them, if you will.
Okay.
Can I add one? Also, you have automated margin calls, right? Because you can program all your margin calls with stablecoin.
Yeah, that's right. And so you can programmatically say, okay, I've given out a loan. At this point in time, I'm going to do a margin call. At this point in time, there will be an auto liquidation, and all of those rules can be nicely coded in.
And so the loan is denominated in a stablecoin. How does the repayment happen? Is that also in stablecoin? If they want it.
Yeah, so we're flexible. We can give out a loan in stablecoin. We primarily use USDC or dollars fiat, and then the repayment can happen in either one as well.
Do you guys see challenges from, sort of sovereign federal banks such as Fed 24, I believe it's called, or Fed Now, I'm sorry, it's called, which is like an instant payment system, which is supposed to kind of settle the same day. I don't have all the facts on it, but do you see challenges to stable coins from that?
Yeah, I mean, I think it's a general win for consumers, right? Like you're speeding up the process. Like stablecoins in and of itself as like a business, I'm less concerned about, but more so what makes money move quicker, what's more accessible, transportable, things of that sort. And so I think actually pushes everyone in the right direction. And as you start getting money markets on chain, that starts putting pressure on stablecoin issuers to maybe start offering some of the yield back. And whether they do it or not is another question. But I think all of these sorts of things are generally positive for the ecosystem.
Anyone else thoughts on this?
Yeah, I would agree. I think innovation pushes traditional finance to, up their game and reevaluate a lot of the products that they have in the market, especially in terms of settlement speed, et cetera.
I will say that FedNow is centralized currency, which is fundamentally different than decentralized currency. So, yes, it is faster, but I feel like it's not the same as transferring money to, if I'm settling my accounts or if I'm managing accounts in different countries, it's not it's still the US dollar.
Makes sense. In terms of compliance, what are some of the biggest challenges that exist as far as tokenizing capital markets, right? We have, obviously, we'll talk, if we have enough time, we have about 6 minutes left, but want to talk about sort of the retail or the democratization of capital markets. We have the institutional capital markets, but whether it's in any one of the two, what role, where does compliance sit now? Where do you guys see potential issues today and solutions down the road?
I think the biggest hurdle to get over is just the legal costs and admin costs that are associated with it still. If
so
we're able
compliance.
to, yeah, exactly. If we're able to streamline the cost of tokenizing assets, it would be moving much faster, but current U.S. regulations don't allow that. Hopefully someday, we'll see.
Yeah, I'd agree. I'd say like we're more of a clean-cut business in that we don't have a token. There's a standard sort of set of rules that apply to lenders where there's licenses that are known at the state level. But even then, you still face challenges with just opening a bank account. And various banks are still hesitant given you have crypto exposure, even though it's held at Anchorage and BitGo and other well-known institutions. So I think there's a lot of work to be done on just making sure there's clarity about what types of businesses you fall under. Do you have a token? Are you under a different sort of regime or set of rules? And making sure everyone understands how to appropriately follow these guidelines.
I have run a broker-dealer in the digital asset space. I'm very familiar with regulation. I am now responsible for a blockchain, which is not the same regulation, but we do have a liquid token. So as you mentioned, there's a little more, I guess people are more critical with the token involved. We are a proof-of-work blockchain, similar to Bitcoin is a proof-of-work blockchain, and we have done all of our token sales internationally. We have not done any in the U.S. It's actually very difficult to get our token in the United States, but we're working with more, not because we think that we're a security, we fully believe that we're a commodity, but it's just we were concerned. One of our founders worked for the SEC prior, and so we've always been working within regulation. So it's a little bit different from I'm always reminding the team we're just the tech layer. Like we're not going to create securities or a DEX or a perp DEX. Like people can create that on us only because we need to remind that we are a technology company and we are not a finance company.
Isn't that amazing that a U.S.-based company, I believe you guys are U.S.-based, am I correct?
We are.
With an ex-SEC employee cannot raise capital in the U.S., right, because of regulation.
We were concerned. We always want to make sure that we are following the law. We are very legit, legal oriented, regulated oriented, but yes.
Understandably so. How about democratization, like getting regular folks, whether it's in this country, across the world, into some of these offerings that are, whether they're debt, equity, or savings account, things like that. Where do you guys see that whole thing today and in the near future as relates to tokenization?
Crypto really opens up capital markets to the global retail scale. Similar how Robinhood has opened up brokerage landscape to retail across the U.S. and other markets. being able to participate in a token offering. All you need is a phone. You can be anywhere in the world with a internet connection. So I think there's a ton of capital that hasn't been tapped previously that's now accessible.
Yeah, I think that's right. But then the flip side is also just making sure you're marketing these products correctly. You're saying what you actually do, and what you realize is actually a lot of retail capital is more mercenary. And so, sort of floating around, and how do you actually build a sticky customer base? And it all just comes down at the end of the day, the product that you're offering and the sort of return profiles, as well as how well the audience knows what they're investing in. Because some of these asset classes, private equity, esoteric debt, is not well known, and as a result, you end up doing a lot more work just on marketing and doing user education, if you will, on what these investments are, how they generate returns, things of that sort.
So I want to take it a little bit different direction, but first I would say I really think that DeFi and TradFi will merge. I believe private credit is the first step for that. I believe there's just the KYC AML element that needs to be brought in. But I also want to point out, look at the changing demographics and the changing dynamics. So you mentioned Robinhood. Robinhood, I think 85% of them, of the accounts are under the age of 35. So if you look at Millennial and Gen Z, who will be receiving this great wealth transfer, which is the change of wealth going from the baby boomers really to Millennial and Gen Z, who are half the population, and they will have more than the half of the wealth. They were born with a phone in their hand. They were born with a supercomputer, and everything is expected to be digital. And so I believe that will help speed things along, as will AI, because you can program and code faster. And I think the expectations, both from a retail investor and from the companies, like millennials are starting to run the companies. And so I think that's also, we need to think ahead as opposed to the status quo about where finance is moving.
Yeah, awesome. We have a couple minutes left here. I don't know if we have any questions from the lively audience.
Hey, John with Manage Life. I'm really curious, since we're talking about the transformation, the whole financial landscape here. Do you think from the crypto, like DeFi right now, we can offer better terms for traditional lending, especially in home mortgage or loan credits right now?
I think fixed income within DeFi has a long way to go. Just the volatility right now, it's not on par with treasury or bond markets. Maybe eventually, when we have a DeFi LIBOR that a lot of financial products can build on top of. But right now, the speed at which rates change and yields are bouncing around in DeFi, I think it's going to be some time before it reaches the same scale.
I would also, for home loans, we compete with Fannie and Freddie, which are the government-backed entities that are actually guaranteeing loans and offer better rates. So until Fannie and Freddie start accepting digital mortgages, it's going to be harder to compete on that rate, which is what people look for when they're looking for a home loan.
Yeah, and the last thing I'd add is I think we need two more pieces. One is just size. The size of traditional lenders is still going to outpace what the amount of loans that happen in DeFi. And then the second is really with respect to long-term capital, and that's why, as you alluded to, the rates on some of these protocols just vary every single day, and it becomes hard to maybe fix long-term expenses accordingly.
Awesome. Well, I think we're out of time. Thank you, panel. Thank you, audience. Oh, sorry. We have, okay. Oh, it says 0. All right.
Hello, everyone. Great panel. Thank you very much. My name's John Calora, and a question, I guess, for Annelise. Mike Cagney, a figure, mentioned recently that it's like multiple trillions of dollars of market cap to be disrupted when there are these tokenizations of whether it's home loans, first mortgages, and everything else, stocks and bonds. So, of course, that could disrupt a lot of these larger institutions because they could generate revenue in some of those areas. But you talk about how there could be the benefits to doing that, whether it's a stable coin where you're getting access to the capital sooner and you could reinvest. So there's kind of the trade-off there. Can you talk about how institutions are thinking about this and why they're not making a decision to do this, or what the first movers are prioritizing that others are not?
So I think the way finance is set up, especially if we're dealing with the banks and public companies, is if I'm a CEO, quarterly I have to respond to my shareholders, right? And I think the cost of innovation is, someone has to bear the cost of innovation, and there's always risk associated with that. Maybe if it works, and maybe it doesn't, right? And so, like Cagney created a huge program, and since he had the program, he was able to highlight the fact of how much he saved. So I think there's a lot of people waiting on the sidelines. I do think some of the first movers for tokenized funds, for example, like Franklin Templeton, if you look at Franklin Templeton, they're a public company, but they're more or less private because they're held by the Johnson family. So, there's not a concern of being kicked out. And so I feel like they're thinking it from a family office perspective, right? A generation of wealth perspective. So they're more into innovation. That said, if you look at what they've done, they have gone on multiple chains. And what they're also doing is not just offering to their current investors the opportunity to buy these tokenized products, they're offering it to the ecosystem of every chain they built on. And so it's also thinking about how do we expand, because the world is expanding, how do we get more retail clients? So I feel like they're very thoughtful in that sense. I feel like BlackRock as well is finding opportunities they're finding opportunities to make money, right? Look at Ondo is more or less built off BIDL, which is BlackRock's tokenized fund. So I do feel there are people forward thinking and the leaders. And I will say BlackRock did not say, I'm going to be a leader. That was not the goal. A lot of people want to be followers. But now that you have the largest bank in the world by AUM, and admittedly the bank beneath it is half its size, another American bank, before you hit a Chinese bank. And then the largest asset manager in the world is tokenizing as well. So I feel like people really need to start paying attention and figuring out how this works. It's just, one, education, getting your head around it, and two, it's hard to recognize how much money I'm going to save or make. And so that's what I think the holdback is, because I still get my bonus if I do what I'm supposed to do, but if I add volatility in there and innovation, am I still going to hit those marks? So I feel like you're going to have more private companies come out, and I do think you'll have companies be acquired, institutions acquire companies that have developed innovative tech or things that might put them out of the market. I mean, that float, Jeremy brought up the great point of there's a float, right? When the bank holds the money, they're making money off of it. And so they're going to have to find ways to make money off of what they used to make money off of. But again, we make money when interest rates are high and low, right? Look at the 80s, right? There are opportunities, and there's a lot of smart people out there to figure out how to. I'll also put out there the Gen Zs, 85% of a study done in the UK get their financial information from finfluencers. Think about the whole RIA market, right? You have this whole generation that is going online to a totally different social media source. And so I think you're going to have and I think the more bespoke opportunities out there, the more you're going to need a financial advisor. So how do you attract the Gen Z, which is a huge load of money? So people just need to think about business lines and how do they think forward, and not just what they have today. Or you've got Kodak and you've got AOL, right? You're not adapting to change.
I'd say from a more macro perspective too, it's just spreads are being suppressed across the board of all financial services. So essentially they're becoming distribution warehouses with brand names. So they have to stay at the forefront of new products to continue to make money, in the future. You saw it originally with payment rails in the early 2000s. Now there's 5 or 6 conglomerates that control most of the volume. You saw the brokerage M&A over the last 5 years. I think other areas of financial services are going to feel those same market pressures, and they have to stay looking to the future because they know their margins are going to decrease.
Can I add to that as well? Look at the largest data companies in the world. Number 1 is IBM. That's their sole business. Within the top 10, you have Google and you have Amazon as just data companies. It is neither of their core businesses, and they're Web 2 companies, but they have created something that that competes on a sideline business that is huge and global in scale. I think similarly, we will have Web 2 companies that come out to rival the size and scale of some of these financial institutions.
Hi, my name is Carlos. Question, how much does consensus impact the capital markets? So for example, if something's proof of work, I think Kadena is proof of work, correct?
Yep.
So proof of work versus proof of stake, is that something that financial institutions are really looking at for capital markets, or do they not really care how that's being done?
I would like to think that since proof of stake is technically more secure, proof of work is technically more secure than proof of stake, because proof of stake you're dealing with, whoever has the most money staked is able to, is able to in essence make decisions. I will say, talking to institutions, they say the majority of the world now is proof of stake, and a majority of the transactions oriented are that. So I think that there's a real that people very much like proof of work, and this is the feedback that I get. A lot of it has to do with energy consumption. They're concerned about what are my investors going to think with energy consumption, but then we found a way to do it at lower energy consumption. But we're also, we're really just coming out now, and all the other competition has gone to proof of stake. But so I will say that institutions like proof of work better, but they haven't yet built on proof of work because there hasn't had the opportunity after Ethereum switched.
Yeah, I'd say, at least from my experience, it's more so been, look, like this is more of an abstraction to us, but what is the ease of use, and then what are the economics or savings to me? And that's been the key focus area, because the sort of underlying details are important in a sense, but really the main driver and incentive for them to invest in these like tokenizations is really for the return or savings that they're getting.
And most of them have been trying it out, to be honest. Like there haven't been, I totally agree with what you're saying. Not everyone looks at the technology as deeply as a technologist would, but they're testing what else is out there.
I'm pretty excited about finance on proof of work. It's pretty early at the moment, DeFi and Bitcoin, but it's coming. Obviously, proof of stake dominates the market at the moment. Bitcoin's already proven itself. People are starting to realize, all right, we can actually build on top of Bitcoin. It's going to be slow, but it'll happen.
All right. Thank you, panel. Thank you, guests. Thank you.
Thank you.